Decoding market reactions, the impact of corporate earnings reports on stock prices. In the realm of financial markets, few events carry as much weight and anticipation as corporate earnings reports. These quarterly snapshots of a company's financial health serve as a crucial barometer, guiding investors through the labyrinth of stock valuation. Understanding the profound impact of corporate earnings reports on stock prices requires a closer examination of the intricate relationship between financial performance, investor expectations, and market dynamics. The earnings report unveiled. Corporate earnings reports, often referred to as quarterly or annual earnings releases, provide a comprehensive overview of a company's financial performance during a specific period. These reports disclose key financial metrics, including revenue, net income, earnings per share, EPS, and often include management discussions and analyses. Investors eagerly await these reports, as they offer a glimpse into the company's operational efficiency, growth prospects, and overall resilience in the face of market challenges. The immediate market reaction. Upon the release of earnings reports, financial markets undergo a whirlwind of activity as investors digest the information and recalibrate their expectations. The immediate market reaction to earnings reports can manifest in stock price movements that reflect the collective sentiment of investors. Positive surprises, such as earnings exceeding expectations, often lead to a surge in stock prices, while disappointments can trigger sharp declines. Consider a scenario where Company A, a technology giant, releases an earnings report that surpasses analyst projections. The stock of Company A might experience a sudden uptick as investors rush to capitalize on the positive news. Conversely, if Company B, a retail entity, falls short of earnings estimates, its stock may face a swift decline as investors reevaluate the company's valuation in light of the unexpected setback. Guiding investor expectations. Earnings reports serve a dual purpose in guiding investor expectations. Beyond the immediate market reaction, these reports influence the narrative surrounding a company's future prospects. If a company consistently outperforms earnings estimates, it can foster confidence among investors and analysts, bolstering the stock's long-term outlook. On the contrary, a pattern of missed expectations may erode investor confidence, prompting a reassessment of the company's growth trajectory. For instance, consider Company C, an emerging pharmaceutical firm. If its earnings reports consistently reveal groundbreaking developments in drug research and development, exceeding market expectations, investors may view the company as a frontrunner in the industry. This positive sentiment can attract new investors and potentially drive the stock price higher, illustrating the enduring impact of earnings reports on shaping investor perceptions. Analyst revisions and market sentiment. Corporate earnings reports trigger a ripple effect that extends beyond the immediate aftermath. Analysts, tasked with interpreting the data and forecasting future performance, often revise their earnings estimates based on the information gleaned from the reports. These revisions, in turn, influence market sentiment and contribute to ongoing stock price movements. Imagine Company D, a manufacturing powerhouse, releasing an earnings report that falls in line with expectations. While the market reaction may be muted initially, subsequent analyst upgrades could fuel renewed interest from investors seeking stocks with upward earnings potential. Conversely, if a company consistently misses earnings estimates, it may prompt a series of downward revisions from analysts, leading to sustained downward pressure on the stock price. Sectoral and macroeconomic implications. The impact of corporate earnings reports extends beyond individual companies, resonating throughout entire sectors and even the broader economy. Strong earnings reports from key players in a sector can stimulate investor confidence, propelling not only those individual stocks but also lifting the valuations of other companies within the same industry. Conversely, a string of disappointing earnings reports can cast a shadow over an entire sector, triggering sell-offs and influencing market sentiment. Consider the technology sector, a driving force in the global economy. If leading technology companies collectively release robust earnings reports, it may contribute to a broader bullish sentiment in the market. Investors may interpret this as a positive signal for the sector, leading to increased demand for technology stocks across the board. Conversely, lackluster earnings reports from key players in the sector can have a cascading effect, dampening investor enthusiasm for technology stocks as a whole. Long-term strategic implications. While the immediate impact of earnings reports on stock prices is evident, their significance extends far beyond short-term market fluctuations. For investors with a long-term perspective, these reports offer invaluable insights into a company's strategic direction, competitive positioning, and ability to adapt to evolving market conditions. Consider Company E, a renewable energy pioneer, whose earnings report reveals substantial investments in cutting-edge technology and a strategic vision aligned with global sustainability goals. Long-term investors may interpret this as a signal of the company's commitment to innovation and its potential to capitalize on emerging trends. Consequently, the stock may become an attractive option for those seeking to align their portfolios with companies at the forefront of transformative industry shifts. Conclusion. In the intricate dance of financial markets, corporate earnings reports emerge as pivotal moments that can shape the destiny of stocks and influence the trajectory of entire sectors. Investors, armed with a nuanced understanding of the multifaceted impact of earnings releases, are better equipped to navigate the ever-changing currents of the market. Beyond mere numerical figures, earnings reports encapsulate the narrative of a company's journey, providing a dynamic and real-time account of its triumphs, challenges, and future aspirations. As investors and analysts scrutinize these reports for cues, the ripple effects resonate throughout the market, creating a symphony of reactions that underscore the enduring significance of corporate earnings reports on stock prices.